This video will cover material in Chapter 10. It's put-call parity, and it has to do with European options only. So the focus of this put-call parity is a European option put-call parity. And basically what it boils down to is this: the value of a call minus the value of a put, European, must equal the stock price minus the present value of the strike. That's what the put-call parity boils down to. You've seen something very similar when we did boundary conditions. What you saw earlier was the boundary condition for a call option. The call option had to be greater, so this was a lower bound, of the stock price minus the present value of K on a non-dividend paying stock. Here, we're actually, instead of having a greater than or equal to sign, we've got a complete equal sign. And this parity condition is very powerful. You'll see it in a number of contexts in the future. It'll be very helpful. But let me show you here what's going on. You know, you might want to say, like, what the heck does this really mean? Well, what it's telling you, what this equation is telling you, is that this side, obviously, the left-hand side, has to equal the right-hand side. But obviously, that's not very helpful. What's helpful, I think, is to understand that under no arbitrage conditions in an efficient market, the options market, which you can conceptually think as being conducted in Chicago, here, should match up with the stock market. Think of it conceptually as being New York, and then the present value of the strike, which is a function of the risk-free rate, which is determined in the treasury markets. So what I'm saying here is that at any given point in time, if you take the value of a call minus the put on the same stock with the same strike, and these options have the same expiration, so we just be careful, then these call options that are determined on the Chicago Board of Trade will match up with what the stock market's doing and what the treasury market's doing. It's no accident that this relationship works all the time, any given minute of the day, for any particular stock. So let's be careful again. It's European. It's calls and puts on the same underlying security, S, so the same underlying stock, and this put and the call have the same expiration and the same strike, K. So what I want to do now is I want to derive it, because this is a fairly important relationship, and I think it's important to derive. Okay, so now what I'm going to do is I'm going to build a table to derive this. I'm going to look at today's value of some positions. I'm going to look at payoffs at expiration, and I'm going to say, look, like we saw before, the stock price is less than K. The stock price is greater than K. So we got all the bases covered. And then I'm going to have on over here is portfolios. Okay, or a portfolio. Okay. So now, here's my portfolio. Now you would never, by the way, you would never think of doing this on your own. People have been playing with options for quite a long time and figuring out how their pricing works, but this would never occur to people if you're new to the market. So don't in the derivatives. So don't worry that you would have thought of this. But nevertheless, it's a quite powerful relationship. Okay, so what we want to do is we want to go long a stock. Okay. And today's value of that stock is S. Call it S subscript 0 if you want, but I'll leave the subscript, that subscript out. And I could, by the way, put little capital T's in here. So we have a long stock, and we'll figure out what the payoffs are at expiration in a second. Let's look at the rest of the portfolio. We're going to go long a put. Okay, and the value of that put is going to be PE. Okay, now we're going to also short a call option. When you short a call option, the value is minus C, because what is its value? It's in a sense negative, because you've sold it, and you're not holding it. Somebody else holds it on the other side, and the person who holds it on the other side, it's worth the C subscript E to them. Okay, now let's look at the value of the portfolio today. The value of the portfolio is the stock price plus the put minus the call. That's an E there if you can't read it. It's an E. Now, let's figure out, so that's the value of, this is the value of this portfolio. Let's figure out the payoffs at expiration. Now, the payoff at expiration for the stock is ST. In fact, the value of the stock doesn't matter. It doesn't matter what K is and where it is relative to K. The stock is the stock price at expiration. So S capital T. Now, the value of a put, when you're long a put and the stock drops below the strike, the value of the put is K minus S. That's the payoff. If the stock is above the strike, the payoff is 0. With a call, the payoff is 0 when the stock is below the strike, and when it's above, the payoff is S minus K. Go back to the very beginning of options, which is, again, reason why I told you to memorize those payoffs, the puts and calls, because we're using them again, and we just did. Okay, let's add this. Oh, put a little t here, put a capital T here, with capital T. Now, let's add up each column. Well, the STs cancel, and all you're left with is K. The STs cancel. As you can see, the STs cancel, and a negative is positive, so all you're left with is K. And so what do you have there? Now, how do you interpret this? Well, the way you interpret this is no matter what happens, this portfolio is going to be worth K at expiration, which means this portfolio is risk-free. This portfolio of owning a stock, owning a put, and shorting a call is risk-free, because no matter what happens, this portfolio will end up worth K. All right? So therefore, you can write this out as saying the value of a stock plus a put minus a call equals the present value of K. In other words, you could think of this as the value of a stock plus a put minus a call is really the value of a bond that pays off K, because there's no difference. There's really no difference between investing in this today and investing in a bond that's worth the present value of K, because this bond will pay off K at expiration. Now, you see how the form I have it here, it's the same form I just showed you a few minutes ago, but I had it rearranged. So if you algebraically manipulate this, what you'll end up with is the call minus the put equals the stock price minus the present value of K. Now, what I'm trying to say here is that when you go to various sources, including our textbook, you will see this formula written in a whole bunch of different ways. Here, what I do is I've memorized it, and over the years, I just automatically revert back to this form, so I don't get confused. So memorize a form as to what this looks like, and so that you can manipulate it easy. But I like to look at the options on the left and the other things on the right hand side. Now, don't forget, if this is a dividend paying stock, you just, as we've done with the other boundary conditions, should just subtract off of this equation the present value of dividends. And now you have a formula adjusted for dividends. Let's go through an example. The example is the Tasty Cake Baking Company. It's in Philadelphia, I believe. Stock trades for $53. European call and European puts with a strike of 50 are valued at $674 and $251 respectively. And these are European options. The expiration is 6 months from now. So that's stock price. Now it says using the put-call parity equation, show that put-call parity holds. So it's 674 minus 251 will equal 53 minus 50 e to the minus o. Oop, I forgot to put the 5. R is 5%. R is 0.05 times 1/2. And we get 423 equals 423. Okay, put-call parity holds. In other words, what's showing up in the options market is matching what's going on in the stock market and what's happening in the treasury market. Now, let's go a little further. And what the next question is saying, what happens? What would happen if C equaled $5? What would happen? Would there be an arbitrage situation if C was worth $5? Well, we just saw the arbitrage condition. The arbitrage-free condition was it should be priced at $674, and we're saying what happens if you find out it's priced at $5.50? Well, it's telling you something's mispriced. We ought to be able to make $1.74 in profit. That difference. So let's see if we can put together a strategy to take advantage of it. And if we do that, this strategy will be better able to understand put-call parity. So, let me put together a table. And then I'll explain some details here. Now I'm going to build a table, and we're going to look at the initial cash flow, and then I'm going to look at the stock price below the strike, and we know the strike is $50. We know it's 50. We're going to say, well, what happens if this stock price is 40? What happens if the stock price is actually 40? And what happens if the stock price here, when it's above the strike, is actually at 60? And so we're going to put specific numbers in there in this problem. So now let me go down a little bit below here for a second and show you what I'm trying to do. We know that the theoretical value C should equal 674, but it actually trades, the call actually trades for $5. So we ask ourselves, what are we going to do here? Should we buy the call or short the call, sell the call in order to make a profit? Well, I think we want to actually buy it at $5. It's cheap, right? We want to be able to buy this because it's trading in the open market for $5. It should be worth $674, so we're getting a good deal. So if we're going to buy this, then that means we're going to have to sell the other side. This is what I mean. We start off with the call minus the put equals the stock minus the present value of the strike. Okay? What I want to do is get the call on the same side, on one side. Okay? I want to buy this side. I want to buy, which means I want to sell this whole side. Okay? To do an arbitrage situation. So what I want to do is I want to sell the stock. Okay, so what I have to do, since I want to sell this whole side, I got to put a negative sign. I have to multiply the whole side, this whole side, by -1 essentially. Put a negative sign in front of everything. So really what I want to do is I want to short the stock. That's what the minus sign, short the stock. I want to a negative, and a negative means I want to buy a bond that's worth the present value of K. That's what I want to buy the bond for today. And I want to put a negative sign in front of the put, and I want to write the put, in other words, short the put. So keep in mind, I want to buy this side and I want to sell this whole side. In order to sell it, I got to flip the sign for each one of these elements. And I just did. When you flip the sign, the negative sign means short and the positive sign means buy. You have to get comfortable with that. It is a little confusing, but I think I got it. I think I explained it reasonably well for you so that you can get a handle on it. Because it is, and I will grant you it's a little confusing. Okay, so let's go back up here now to our table, given we know what we want to do here. So what I want to do is I want to buy the call. And we're going to actually put numbers in here. -5 is the call. Okay, and when the stock is below the strike, the option's out of the money, and so the payoff is 0. Okay. Now, when the stock is above the strike, it's going to be, and in this case it's going to be, I'm using a 60 as an example, 60 minus the 50 K is going to be a $10 payoff for the option. Okay, so far so good. We want to short the stock, in which case we're going to gain in cash flow $53 today. It's going, and we're going to have to buy the stock back at expiration, and when it's worth 40, we're going to have to pay 40 for it. When it's worth 60 here, we're going to have to pay 60 for it. So you can think of that as the payoff to this stock. Not the profit, but the payoff to the stock. Now, we want to short a put. And that means we're going to collect $251. We sell the put for $251. And the put is going to be worth K minus 40, the stock price. And so it's going to be worth minus 50 minus the 40. Because remember, we're short, and so you got to put the negative sign in front of the payoff, which is K minus ST. And this is going to be minus $10. That whole component. This whole thing here is worth minus 10. The option is out of the money when the stock is above the strike. Now we're going to buy a bond. The bond's going to cost us, we want to get this to be 0. Remember that? We want to get this to be 0. In order to get this to be 0, we've got to pay $50.51 to buy a bond, so we make sure our cash flow is 0. So this is, in a sense, a plug to get this to balance out. It's going to mature in 6 months, and given interest rates are 5%, it'll mature at 51.79, and that's 50.51 times e to the 0.05 times 1/2, give you 50.71. And that doesn't matter where the stock is relative to the stock price, relative to the strike. Just doesn't matter. These are 7s here. Add this up, you get $1.79 and $1.79. Like, okay, look, no matter what happens, we get $1.79 in payoff at expiration. You're going to say, well, wait a second, Bert. Didn't you just say that we were going to make $1.74? And I did say that. Yeah, we're going to make $1.74. The difference here. Why is it $1.79? Well, this is $1.74 in today's money. This is in future value money. Take the present value of this, and the present value of $1.79 discounted at 5% for a half a year equals $1.74. Okay, so there you got it. It's a risk-free strategy with no money down payment, right? No money down paid. It's risk-free. No matter what happens, you get the same situation. And so there's an arbitrage situation. That shouldn't happen. And in fact, if you go through the whole scenario, putting in a call with a value of 674, if you plug in 674 for the analysis up here, you'll come up with zeros in the table, which means it's arbitrage free. Let's do another example. Suppose Apple stock is at 570. This is before it did a split. R is 2%. Strike is 560. And the premium, let's see, call has a premium of $17. Now it says, what is the value of a May put? Okay, these are May. The expiration is May for these. So it's asking, what is the value of a put? Now, how do you figure that out? Well, you use the formula I just showed you, and you back into K, because I've given you all the unknowns, given you everything except one unknown, one equation. Means you can compute an answer. 17 minus price of the put equals 570 minus 560 to the E minus 0.02 times 1/2, and we get P equals 421. The value of the put is $4.21. Now, this is a very useful tool called Parity, like I said. If you study options, you'll realize, and you don't even have to study options. Just go to the Chicago Board of Options Exchange. Look down, go to Google, go to any high volume stock, and look at the number of calls and the number of puts that trade on any given day. And you'll see that the volume of call options are much higher than the volume of put options, meaning there's a lot more traded of calls. So what happens is, right at the end of the trading day, let's see if I can draw this graphically. I'm not sure if I can draw it. Think about how to draw this graphically. Here's the end of the day. Okay, right at that point. So maybe think of this as 9:30 or whenever the option opens up in the morning, and this is the afternoon, the end of the day. The problem with options are there's so many hundreds of options on a particular stock that those options are not that liquid. The last time that a put may have traded, the last put may have been traded right here. Could have been an hour or two ago. And maybe the last call was traded right about here. So when you price everything, you price the stock, and you want to you know what the price of the stock is, and you know the price of the call, but you really don't know what is the value of the put right at the end of the day. You don't really know that. So what does the newspaper do? The newspapers and various websites at the end of the day will post closing option prices. They'll get this call price, but they'll hesitant to put in the closing put, or the last put price that's available, because it could be very stale. It could be hours stale. Stock could have gone up or could have gone down significantly since in this hour, 2 hour time frame. So what the financial press will do is they will plug in whichever variable here is the latest, and if one of these numbers is stale, they'll just get this stock price, because that's always relevant. It's prices trade, stock trades all the time. Interest rates are always updated. So this side is always updated. One of these is always updated. And if they have stale information for one of them, they just back into it using put call parity. The Wall Street Journal does this. I know so because if you read the fine print to the, for example, the foreign currency options, you'll see that they invoke put call parity if they don't have a call on the put that's traded right at the end of the day. And if they're traded right at the end of the day, then they're subject to put call parity anyway through arbitrage conditions. Okay. What I want to do is one more thing here. This will take a few minutes. And that is, I want to summarize now. We're in a good point to summarize the 6 variables that drive option prices. We know what those 6 variables are. And so what I want to do is make sure that we can explain that. So this is a good summary of what we've done in chapters 9 and 10. So we know that you got the stock price is one of the variables. We know the exercise price is one of the variables. We know that time to expiration is one. Stock volatility is one. Interest rates are one. And then dividends is one. So what I want to do is I want to build a little table of pluses and minuses for a call and a put. And the way we're going to read this is, ask yourself what happens if one of these variables increases. What happens to the value of the call? What happens to the value of a put if one of these guys increases? So let's go through row by row. If the value of a stock goes up, then we know that the value of a call goes up because calls increase in value when the stock goes up. They're bullish. But when the stock goes up with a put, the put goes down. The put goes out of the money, and so it drops. Now, if you could change the strike, and remember, you get her into an option, the strike is fixed. But if you could change the strike, or you could go down to the CBOE to the website and look at the postings, and you look at different strikes, you'll see that when you go up to higher and higher strikes, the value of the calls drop. And that should make sense because the strike is what you pay, is the price that you're going to pay when you exercise the option. If the price you pay is going to go up, the call is worth less. And for the put is the sales price. The K is the sales price for the put. So if the sale price goes up, the value of the put goes up. So far, not too bad. Now, time to expiration. With call options, the longer the call, the more valuable the call. Remember what a call does. A call gives you the right to defer the purchase because you can defer exercising over the life of the option. So there is time value associated with a call option. Okay. Now, with a put, I'm going to put here plus, but I'm going to put an asterisk here in that it's usually positive, meaning that the longer the put, the more valuable the option, but it's not always the case. And let me explain here. The plus sign here always holds for an American put. Okay, it always holds. The little asterisks here apply to European puts. And with a European put, things are a little more complicated, and it has to do with you have to trade off that time value versus the insurance value as to which one's more valuable. So what I'm saying is, remember what a put is. A put, when you hold a put, it actually delays you receiving the strike. Okay, so if you hold a put, it delays you receiving the strike, which means that counts against you in terms of time value. We saw that when we looked at a put and we said, look, the put has an intrinsic value worth K minus S. Okay, as long as that's positive. And we saw that there was minus a time value, and that time value is K minus the present value of K plus an insurance value. So the question is, with a European, I'm talking European now, which is bigger? And so and so you have to, at any point in time, you have to ask yourself, if you were to try to increase the time, look at the increase in time, you're trading off, depending on where the interest rates are to affect this present value. You're looking at that and comparing these two. Remember, with a call, this term right here, this term was positive with a call, but with a put, it's negative. So the point I'm trying to make is that usually, with Americans, it's for sure that American options are worth more the longer the time value is, the time to expiration. But with Europeans, it's almost always the case, but there could be exceptions to the rule. And the exceptions to the rule are driven by this relationship that we looked at earlier. Now with volatility is straightforward. No matter what happens, volatility goes up for puts and calls, the options are worth more. Now, one thing that's a little more that's tougher is with interest rates. And when interest rates go up, the call goes up and the put goes down. Now I have to explain this guy. This will take a little bit of effort here. Now, here's the story. You buy a call, right, when you're bullish, and you can buy a stock if you're bullish. So if you're bullish, you have two choices: buy a call or buy a stock. But now think about this. In terms of the opportunity cost of money, which is R, what's it going to cost you? More to buy the call or more to buy the stock? The stock itself. Well, you know that calls are usually really small. You know, they could be worth a nickel on a $200 stock. They could be worth $5 on a $200 stock. So the call is usually worth much less than the stock. So what I'm saying is, when interest rates go up, R goes up, calls become more attractive, because if you're bullish, you can buy the call option, which is very cheap. It won't take a lot of money to pull out of your savings account or out of your pocket to buy a stock, to buy the call. So calls become more valuable relative to the stock. Now with a put, just the opposite happens. If you're bearish on a stock, you have two choices. You can short the stock or you can buy a put. Now think about it. Short the stock or buy a put. Well, if you buy a put and interest rates go up, that means your opportunity cost of money is just increased. And then what happens if interest rates go up and you can short a stock? Well, remember, if you can short a stock, then that money sits in a bank account and earns interest that the broker will pay you. So when interest rates go up, shorting a stock is more attractive than buying the put, which actually has an opportunity cost associated with it. So in other words, what I'm saying is, when interest rates go up, the value of the put drops. Okay? And so I'm working off, in both of these cases, a call is a substitute for a long stock, and a put is a substitute for a short stock. Okay. Now, these first five variables are all, and when I did all this analysis on the first five variables, I said ceteris paribus. I was using a ceteris paribus analysis. I'm saying, look, the stock changes and nothing else changes. What happens to the call and put? K, if you could change it, what would happen to the call or put? Time, if all you did was allow time to change, what would happen to the call or put? If all you could do is change volatility, what would happen to the call or put? And the same thing with interest rates. With dividends, it's slightly different, because when you change dividends, what's happening is two things are happening. When a dividend goes up, and I'm talking about the payment, then the value of the stock will decline. Okay? And so two things have to change. Dividends change, the value of the stock changes. Present value that stock changes. And so when dividends go up, the stock drops. And so there's a negative sign here. Okay? The stock drops. And so when you have a call, when the stock drops, the call is worth less. With a put, right, when the dividend goes up, the stock drops, but that's good when you own a put. So there's a positive sign here. Okay? So there you have it. There you have a nice summary of how the variables influence puts and calls.